Hello everyone, welcome to our part 2 of chapter 3. We're focused now on things that are exceptions to the rule. Remember, the rule is all income is included in on the tax return, is recognized, and gross income are included. And these are the items that are specifically mentioned in the tax law that are not, okay, that are excluded by law from our gross income. So first kind of category or piece is fringe benefits, okay? And they qualify if they meet non-discrimination rules, meaning as your employer provides these fringe benefits, they do so for everyone, not just the head honchos or a few people, okay? There are a list of examples of those. One example, okay, is a no additional cost services provided to an employee. You probably realize that most airlines provide their employees with the ability to fly standby on an airplane wherever they'd like to go. Okay, that's one of the fringe benefits. That doesn't cost the airline anymore because they don't get to fly unless there is empty seats that would have gone anyway. So it doesn't cost them, the airline, any more money to put that employee on in an empty seat for that flight. So that fits that example, that definition of additional cost services, and is not included in income, even though technically as an employee they're receiving a valuable benefit, if you will. Okay, that's something that could be put a value on, but we're saying for the airline didn't cost any more. So it has to be the airline provides airline seats. Okay, railway could, Amtrak could provide that ability for their employees. Hotel rooms maybe could do that, although it doesn't usually happen because anytime that an employee does stay in a hotel room, there is an additional cost, a very minimal amount for cleaning the room. And you could argue that the person in that seat is going to get the drink or peanuts, but that has been considered not to be enough of additional cost to disqualify. And this has been controversial for a long time, and any time that the IRS challenges this, they have lost and the airlines have won, because it's a very common and very widespread fringe benefit that some people go into work for the airline for that very reason. Okay, other ones. Discounts provide to employees, okay? Again, it has to be what you normally sell, not discounts on other people's stuff, but and it can't be more than your gross profit percent. So if you normally buy something for $7 and sell it for $10 as a business, your discount couldn't go below the $7, okay? You couldn't go below $7 as a discount, so that 30%, which is the same as their gross profit percentage, is the most discount you could give to the employee without having it be income to the employee. And then on services, the discount is 20% because there's not the same cost of goods sold issue there. Qualified transportation benefit. You provide parking passes or transportation. You can do that to your employee, for your employees. So for instance, if you but as long as it's not more than $280 per month, okay? If it's more than that, now it's included in income to the employee and have to be on their W-2. Okay, you can provide holiday turkey, things that are considered de minimis, Christmas gifts, holiday company picnics. Technically, is valuable, that meal that they would have had to have bought otherwise, okay? But that is excluded from income, doesn't get reported on the 1040. Others have more, you might say, limitations. For instance, life insurance. You can provide your employee with life insurance as long as it's group coverage and up to $50,000, the value of $50,000. Anything more than that is included in income based on tables that are provided by the IRS, not based on what you actually pay. It's kind of interesting. It could actually be different than what the employer actually pays. But the first $50,000, okay, is going to be paid for the employee with no tax implication to the employee. So that's what HAC does, for instance, for me, okay? They pay premiums on coverage $50,000, okay? Educational assistance, you see the limit, $5,250. We can reimburse employee for any type of classes. It doesn't even have to be related to the job, okay? Or pay off student loans. That's been added recently. They can pay that off. And as long as it's not more than that, it's not included in income of the employee. And they can also pay for dependent care. That's child care for their dependents. Okay, $5,000 a year can be paid towards that, and not included in the income. Again, we have to set it up so that they're paying directly for the child care, that sort of thing. Other non-taxable income, things that have been specifically excluded from our income in the tax law. Scholarships and fellowships. Typically, if it's just for paying tuition or things for that nature while you're in school because of your academic record or because of your financial need, that scholarship fellowship is not included in income. As soon as some fellowships, usually not scholarships, but some fellowships, you have to do some work to get the money. It's not just, and the part that you are being paid for actually working would be income. But the part that is just because you won the scholarship or fellowship is not. Remember, a prize, just a regular prize, is income, but scholarship is not. Okay? You can take money out of a specialized savings tuition program. We'll talk more about that in a later chapter. But those withdrawals up to $10,000 are not included in income as long as you use it for your schooling and qualified expenses for that. Life insurance on the death of paid out because someone died, that is not income as long as you have an insurable interest. So there's some complicating things there, but for the most part, if you buy life insurance, you pass away, okay, your life insurance pays out the beneficiary the money from the life insurance policy. That life insurance is not taxable, not included in income in any way. However, if the life insurance company pays it out over time, then what they're doing is paying out the life insurance, which is non-taxable, not included, and interest, because they're keeping the life insurance proceeds, right? They're not giving it all to you at once. They're giving it to you over time. The part that represents interest would be income. Gifts, okay? Inheritances, money you get from someone who passed away as an inheritance. Gifts you receive at Christmas or in other ways, okay, are not income. There may be other tax implications to the giver, but not to the receiver of a gift, as long as it's not in an exchange for services. So you have to receive the gift because of the generosity of that individual. Okay? If you're pay compensation for sickness or injury, like workers' comp or other types of disability, okay, that if it's paid out not for your lost time, but because you had a particular sickness or illness, injury. So, for instance, you may have a type of insurance policy that pays out $50,000 if you say can't use your arm anymore because you have an injury. That would be not included. Okay, child support is not included. Alimony, we'll talk a little bit in the next chapter, it is depending on when it happened. Welfare benefits are not, and employer-provided adoption assistance is not included in income. There's a limitation on that employer-provided adoption. Okay. Savings bond interest. We mentioned a little bit about interest earlier, and that there are savings bonds. Savings bonds is when you buy savings bonds to help somebody save for education was the purpose of it. Okay. It's not taxable if you use it all to pay the qualified education expenses for the taxpayer, spouse, or dependent children. Okay, so what has to happen is mom and dad have to, for instance, have to buy the bonds in their name so that they receive and then use that money to pay for a child's education. If they receive more than they pay out in expenses, then only part of it would be excluded. Okay, so you have to have more education expenses, and anything that is paid by scholarships don't count as education expenses. And if your income is over the certain thresholds that are listed here, okay, it phases out. Okay, it goes away. You may not get a full deduction, a full amount being excluded from income. Okay, below market interest loans, not going to happen very often. Okay, we have to impute interest, include it in income. Okay, even if there's not actual interest paid, but we can ignore that when it's smaller amounts, like for instance sales of a property were $3,000 or less. Okay, gift loans, which is basically where you say it's a loan, but really, okay, it's to somebody who would normally give a gift, okay, to, and you say, oh, don't bother paying interest on it. Okay, that is still income, even though there's actually no interest, unless the amount again is under $15,000. Okay, and then original issue discount is kind of a complicated scenario where you buy a investment, and what the situation is with certain bonds, you buy or invest, let's say $700, and then at the end of 10 years, you get $1,000. Now, everybody know that that's $700 you're getting back plus the $300 in interest. You would think, okay, that you could wait till you got the full $1,000 to report the $300 in interest. That would not be true. Okay, you have to include part of that $300 every year as you over the course of that bond, even though you don't actually have it, unless, okay, it fits into one of these. It's tax exempt. It's a savings bond, Series E or E savings bonds we mentioned earlier, okay, or it's very short term, or it's between two people and it's less than $10,000. Okay, so there's quite a few situations where that doesn't have to happen, but that is not an unusual way for investments to happen, bonds to be issued in today's world. And so you could have that OID come up and have to report income. Typically, you'll get the information from your broker or the broker involved as to what the OID is for a particular year. because it is a little bit complicated to calculate.